Good afternoon and welcome to JA Personal Finance Workshops. I am Michelle Merkel, President of Junior Achievement in Mahoning Valley. And today we have with us Michael Alexander with TCF Bank, who will be presenting our last topic session on investing. And so how we can save for our future retirement. So at this time, I'd like to turn it over to Mike.
Thanks, Michelle. Yeah, I am Mike Alexander. I am a wealth officer for TCF Bank Wealth Management Private Client Group. So basically what that means is I work with the high net worth clients, meaning the high earning customers who have larger needs from a finance standpoint, to help them with their not only daily banking activities, but also investments in particular. So this is really near and dear to my heart. And so hopefully I sound like I know what I'm talking about. If not, don't tell any of my clients. But we're going to talk about investing. As I said, this is the final, as Michelle said, I should say, this is the final session in this group. So if you were with me here on the risk management side, this one will be a little more fun, a little better conversation. So I'm going to go ahead and get the PowerPoint started here. Are you seeing it, Michelle?
Yes. You're good.
Okay. So here are our sessions, as I mentioned, and we just finished up with the risk management and we're into investing now. So let's get started. Investing is actually a big part of the personal financial picture. As Michelle said, it's used not just for future retirement, which we all are working toward pretty much every day of our lives, but also for major purchases and for just lifestyle in general. There are many components to investing. The primary thing I'll say about that is it goes along with your ability to, as I said, live the lifestyle you want. So many of us will ultimately save up for a home, car purchase, and again, retirement, but also other items. You know, you hear about spending 3 months or 2 months or 6 months of your salary, depending on who you marry, on an engagement ring. So those are other ways that you're investing and saving for the future. In investing, it is one of the components, like I said, you're earning your money, budgeting it, and then saving for large purchases. So the biggest thing that you can do with the money that you saved to increase that money that you've earned is to invest. We're going to talk about interest. We're going to talk about compounding. So these are the types of glossary terms that you hear when you hear about investing. Unfortunately, risk goes into that as well. So this is what we'll really kind of hit on in these next sections here. So we're going to begin, as we do with each of these sessions, with the warm-up. So we'll do the warm-up, the strengthening, the sprint, and the cool down, much like any other physical workout we would do. This is for our memory, though. So unfortunately, we can't do this in a interactive virtual way, but here's the quick question for the warm-up quiz. Which of these is an example of interest? Is it A, a percentage earned on a savings account? B, a percentage charged by a student loan company on the money you borrow? C, a percentage you pay on a credit card to a credit card company that you owe money on a credit card? Or D, all of the above, A, B, and C? Interest would be D, all of the above. So it's not just money that's paid to you, but that you would pay to others if you should use their money. Which of the following situations would make you the most amount of money? So how could you earn the most amount on what you already have? Would it be A, interest paid on a deposit account, such as a checking or savings account at a bank? B, compound interest paid on a loan? C, compound interest paid on a deposit, again, like you have at the bank? Or D, interest paid on a loan? So what does everybody think in your own mind? Answer here, C. Compounding interest is, the answer C, because it means you are not only collecting interest on your original deposit, but you're also collecting interest on all of the interest that you've already made. Your deposit will grow bigger each time the interest is added back in, making your money grow faster. So in a more plain way of saying this, you have $100 in a checking account. If the bank pays you $10 a month in interest, you're going to make $10 the first month, so you'll have 110. The next month, you're going to be making, 10% on that, now not $100, but $110. So you'll actually make more interest the next month, and so on and so forth. It'll keep growing at an exponential pace. Next, in which of the following situations would you make the most amount of money? Oh, whoops, sorry. Reread the same question. Okay, so interest. Obviously, we've already done a bit of a definition of this, but it is a payment for the use of money, a fee paid to use someone else's money, or money earned from allowing someone else to use your money. So it works both ways, as you've already seen from the warm-up quiz. If you are putting money into a bank or an investment account, the interest you earn is paid to you because they're using your money to do some sort of venture that they're doing, whether it's for a business ongoing use, or if it's the bank to be able to use it for what they do on ongoing business, such as loaning out to other people. As I mentioned, it's two-sided. So if you're borrowing money from the bank to buy a house, car, or otherwise, the bank requires you to pay them interest because, again, it's a fee pays to use someone else's money. Next, we talked about compounding interest a little bit as well in the quick explanation I gave. But basically what that is the interest the bank would pay on an account is added back into the loan or deposit, making the original amount larger, which will cause the amount in the account to grow faster each time interest is added. This is a little bit complicated, but basically it's exactly what I said. So when you're starting with a certain dollar amount, the interest that's paid to it will actually add to that, what we would call balance or principal, and continue to pay at the same rate, or hopefully higher someday as rates improve, on that now total balance. So if you're talking about a savings account, you could start with $100. A year from now, your balances has grown because of the interest that's added. You're still earning interest, but it's now on that larger balance each time. So I've heard the phrase used quite a bit over my years of banking called the magic of compounding. At the very end, we're going to have a real quick example to show what the magic of compounding really looks like. And it's actually eye-opening to see on paper. So keep that in mind when we get to that. All right. If you cannot see this, please let me know, but it should be done.
Hiran likes to take risks. When he isn't at work, he likes snowboarding, skydiving, and cycling in the city. But Hiran knows it's important to understand how risks relate to reward, and it's no different when it comes to investing. Risks come in many forms, and different asset types carry different risks. Your capital may fall in value, interest rates change, inflation can erode your investments, and even currency fluctuations may affect the value of your investments. So it's important to make sure you understand both the risks and potential rewards of your investments. Of course, higher risk can mean bigger rewards, but deciding on how much risk to take is all down to Hiran. Thinking about when he might need his money and how much he could afford to lose are really important. Hiran needs to think about his goals in life. After all, you never know what the future holds. Wesleyan, we're all about you.
So I wanted to give you a quick overview of that. I meant to do so before it began, but it started playing right away. So I apologize for that. Hopefully you were able to see and hear that well. But basically there are multiple components to that, as we've already kind of discussed. With investments, there's always that risk, as I mentioned right off the bat. So any investment you take on has an inherent risk of loss. So you can make money, but you can also lose money. So there's always that opportunity. And truthfully, we'll get to this in a short time here, but the riskier the investment, usually the higher the potential for growth, or higher interest you can make, but more likelihood that you can lose all of your money too. So there is a correlation between those that we'll get to. So how else can you grow your money besides savings? It's pretty simple: investing. So once you've gained that money, then you can use that to invest. We've already been discussing this, so this shouldn't be a surprise, but investing is putting your money into a venture that offers the possibility of earning more money. So I'm sure most of you have seen in the news about the stock market, about people talking about purchasing stocks, even to the point of GameStop being a big kind of conversation over the last several months. Basically, what you're doing in that case is buying the shares of the company. That's why they call it a share of stock. You're purchasing a very small percentage of a company and allowing them to use your money that they can then use to increase the opportunities that they have in the business and hopefully provide you a return or an interest on that money, either through a dividend. I'm sure you've heard that term, where they're actually paying you an interest rate of return on your money, or just through the improvement in that stock price. So the more money they have, the more opportunity they have to perform better and grow the ultimate value of the business, which will then cause the stock price to increase. The overall company becomes more valuable, so your fractional ownership becomes more valuable. So GameStop's a very poor example of that, because that company is not making money, but the investment has grown because people are willing to take that very, very high risk to get that return. So investing for tomorrow, you see several pictures here that show, financial, or I should say physical improvements that you can make through exercise, staying young by, riding bikes and playing soccer and everything you see here. So investing for tomorrow is important because it gives you the opportunity, as I've mentioned before, to have a lifestyle that you want later in life, throughout your life, and especially in retirement. So let's get to some of the points that we're talking about with that. When you invest for your future, you're not just looking at growing the earnings that you have, but also how you can use that money that you earn to, like I said, live the lifestyle you want. So that would become investments. Where do you put the money that is most beneficial to you and with the least amount of risk that you can have at those times in your life, and what you're most comfortable with? We're going to be talking about the risk and reward, correlation now, because that's where I've been leading this whole time here with that conversation. This pyramid is the risk reward trade-off. So as you could see for yourself, level 1 at the bottom is almost no risk, but very little to no return. So think of it this way. People joke about putting money under their mattress. They're not going to earn anything on it. There's no return, but there's really no risk of losing it unless you physically lose the money, or somebody steals it from you, of course. So there's no way that someone else could cause you to lose money, if you will. Number 2, low risk, but small returns as the reward. This would be more like a certificate of deposit or a savings account at the bank. Rates are very low, as I jokingly mentioned before, but it's also very difficult to lose money in a traditional bank product, not just because of the strength of the bank and the likelihood of it, performing, but also with the insurance that we talked about in the previous session, FDIC insurance, or for Federal Deposit Insurance Company insurance on those deposits you have. Level 3 would be a moderate risk, but for a potential for higher rate of return over a longer period of time as your reward. I look at that primarily as the stock market, as we mentioned, or other types of investments, mutual funds, annuities, any of those types of things, where yes, there's an inherent risk, of course, because you're investing in another entity, whether it's an insurance company or a business that is traded on the stock market. So there's a risk that they're not going to manage your money properly, and other factors could cause them not to earn the type of returns that are necessary for your level of risk. But the chances of that risk being, that return being higher are worth that risk in many cases. And then 4th, the high risk, but potentially very high reward. You've probably all heard of this, whether it's starting your own business from scratch or investing in someone else that's got, possibly a little bit of a sketchy track record, but they're willing to pay a higher reward because that's the only way they can get money. I want to look at it in a different level as well. I know you've talked about budgeting and credit in the past in different sections. When you have lower credit, you have a potential for paying much higher interest to a bank when you want a loan. That's the same risk reward category, but it's used against you in reverse. So you become a riskier customer to the bank because you haven't paid loans in the past, or whatever reasoning that your credit score would be lower. So the bank views that as an investment in you, but a higher risk. So they're going to charge you a higher rate of return. So they're getting a larger interest on you. So that's a little food for thought there. This is another chart that really shows that same correlation. So as you can see on the bottom, as the risk grows from the left to the right, that's the likelihood of the investment being lost. The left-hand or vertical column shows the reward, or how much you should return or get in return. So as you can see, with low risk and low return on the left-hand side, if you're seeing my cursor in this blue bar here, you're going to have much less risk of losing your money, but less opportunity to gain interest from the company that's borrowing that money from you or using your funds. Whereas as you go higher on this scale, your return gets much higher, but your risk grows as well in a very correlated pattern. As you see, it's a direct correlation. So that's the same with any other opportunity that you're looking for with regard to investments. So the risk reward trade-off, I think we've kind of hammered that point home pretty well about the fact that you will earn better return the more risk you're willing to accept. Let's see if I can get. The investment advisor is one of the interactive things that we unfortunately will not be able to do because of our virtual environment here, but I'm going to share with you another screen, and hopefully you'll be able to see it well enough. This would be what we would have discussed in the activity. This is showing 4 different portfolios. Portfolios are types of investment. The font is very small here, so I apologize if you cannot see that properly, but basically, if you look at a way of investing your money and what a financial advisor would do for you is to have a conversation and decide what level of risk you are comfortable with. And when you're planning for the funds, whether it's for a purchase of a home, like I've mentioned, or retirement, to give a timeline. So there are many components to investing, and I hate to make it sound so basic, but basically it is pretty simple. How much are you willing to risk? For what level of return are you expecting? And for how long do you have until you need that money? So in the case of my retirement, I would hope it to be next year, but I realistically know it's going to be 25 to 30 years. So I will be a little bit more risky with that money, knowing that if it should lose, I have time to make up that loss with other choices I make and with other earnings I have. Whereas if I am really going to retire next year, and if a client of mine is retiring next year, we want to be much more conservative, make much less risk decisions to prevent that ultimate loss, because there's less time for them to be able to earn money back in that case. So as you can see here, each of these portfolios has a different level of risk and potential reward attached to them. So it seems really simple, but this is kind of the basis for investment conversations with our clients. Obviously, it would look a little different here because these things are very generic, but as you can see, just as an example, in portfolio A, 30% of the money that would be in there would be in savings accounts, mutual funds, or excuse me, money markets. 50% would then go into corporate bonds, savings bonds. And then as you can see at the top, much less percentage, 15 and 5%, would be in the more aggressive or higher risk categories. Such as mutual funds and investment equity growth stocks, as it says there. So this would be what we would call a low risk, low reward section. A lot less opportunity for loss, but not being able to make as much money. Where if you jump all the way to column, or rather portfolio D on the right, it's virtually reversed. You have 15% in the very, very conservative corporate bonds and savings bonds, and 60% of it in these growth stocks, which have a potential for loss, of course, but have a much higher potential for large gains if things are going well with the company and with the economy as a whole. So again, this would have been a discussion piece that you would have had an opportunity to work through. So I definitely recommend you looking at that or similar things on your own if you have the opportunity. Okay, so that's the the instructions for that activity. Unfortunately, we're not doing so, like I said. So the debrief with regard to that, what is the acceptable level of risk? What is the right amount of risk that you could take? I think I've already explained that it has a lot to do with the reasoning for the money. Is it something that you're saving for a distant time frame like retirement, or if it's a very, very short-term thing that you need to purchase a home or a car or something like that, as well as what earning potential do you have? If you're still earning money, you have the ability to take on a little more risk, because if you lose, you can replace it. Where if you're retired, the earnings are no longer there, it's all investments. Then we're going to go into the next section, which is the sprint. So we will go through this quickly. It's the true or false. Unfortunately, I won't be able to see what answers you're giving, but if you could just think about those answers as you see them on the screen, and then you'll see if you are correct with your responses. So number one, you don't need a ton of money to start investing. True or false? That's true. There are plenty of options to invest small amounts of money. Research ways to invest $500 or less to learn more. So if you just go to Google and look at small dollar investments or how to start investing, again, in the news, you've probably heard a lot about the retail stocks and the investments we talked about before with GameStop. It's what they call retail investing. It's small dollar investing. Investing is a good way to grow your money now. So if you're looking for a short term and you need to grow your money right now, is investing the right way to do so? It's false. Investing is a way to grow money over the long term. So the sooner you start, the better. You don't have the opportunity to increase through compounding interest, or any interest for that matter, if it's something you need right now. People under age 18 cannot invest in stocks independently. So what do you think? Do you have to be an adult to invest? True. It can be done for you, however. You can have a custodial account that's started by a parent or guardian, or another type of trust relationship, but you personally could not purchase them yourself at age 18 or below. Your cousin's friend offers you the opportunity to invest in a company he says is low risk with guaranteed high returns. Should you make this investment? Yeah, true or false? That's actually false. The risk return trade-off means that the high potential reward comes with risk. If someone tells you otherwise, it's probably too good to be true. So there's no way you can earn, there really is no way you can earn high return without accepting some risk of loss. All right, and that's the end of the little sprint quiz there. Like I said, it's only a few questions. The cool down part. So this will be our quick overview and recap of things, and then we have, I'm sure, enough time for question and answer. But in review, investing is a great way to grow your money over a period of time. The compound interest increases the growth of the money over that period of time. Different investment options carry different levels of risk and reward. So I think that we've actually gotten an opportunity to discuss all these. The one thing I'll mention here is the reason, and I know it doesn't seem logical, but the reason investing is not a good way to grow money in a short term is because you don't get the opportunity to compound that interest and gain the return from the company that you, or venture that you're allowing to use your funds. Okay, I think we're going to go into the question and answer now, because the next one would be another interactive quiz that we do not have the ability to do virtually here. So Michelle, if you are able to do
here. Nick, I was reading over some of the questions. You answered some of these.
Oh, okay.
But if my money is in a savings account, what should my next step be?
If your money's in a savings account now, so obviously it depends on what your purpose is for it. So if it is something you need in the short term, then you might be best to leave it there so that you have it to be able to buy whatever it is you're saving for in the short time frame. But truthfully, if that's not the case and you are looking to invest with someone, you need to find somebody you trust, an investment advisor or a financial advisor, as they're usually called. You could sit down, have a no obligation, basically interview conversation with that person to see if you like what they're having to say, and if you're a good fit to work with them in a long term, because you do not want to make very quick decisions with something like that. It has to be, you're in it for the long haul, if you will.
Okay. So I guess the next question is, are investing apps good to use?
Actually, yes. It's a strange thing that's happened recently, but I mentioned it in a generic term that you can Google and read a little more about if you haven't already. It's what they refer to as retail investing. So usually investments require you to have a certain amount of money to get going, if you will. Meaning, if you want to buy stock in, say, let's say Lordstown Motors, that's been in the news quite a bit lately, you would need to be able to buy at least 100 shares of their stock at, let's say it's $10, which is probably somewhere around there right now, unfortunately. You'd need $1,000 in that case to be able to purchase that. Whereas through a investment app or, Robinhood, E-Trade, those types, you can actually buy individual shares. You don't have to buy a whole block of 100. You don't have a minimum purchase, so to speak. So they are good. They generally charge low fees. You don't get any advice. There's nobody looking out for you, so to speak, when you do that. So you're not getting financial advisor advice. But if you're looking to purchase individual shares, absolutely, that's a possibility.
Okay. So those apps are good.
Yeah.
Okay. And you touched on this. I got a question about how much do stocks cost? And you were saying as little as $10 a share. Are they, they vary, don't they?
They vary completely. In fact, you've probably heard the term penny stocks. That would be any share of a stock that's valued at under $1. So pennies, essentially. So there's a company that I won't name by name, but it was trading at only 30 cents the other day. And I believe today it's over $1. So they are much more volatile because, they're so low priced that any movement is a big percentage change. But yes, they vary anywhere from pennies all the way up to thousands and thousands of dollars per share. If you want to Google Alphabet Company, which would be Google, or Apple, you could see how high an individual share of a stock can actually be priced.
Okay. And then you did touch on this in the Q&A, but what if I'm under the age of 18 and I want to purchase my first stock?
You would actually need an adult, or I should say someone of 18 years or older, in order to put a guardianship, custodial, or trust account in place for you. You could not be a co-owner or joint owner of that until you're 18 years old. But it is an opportunity to start. In fact, my dad did a very wonderful thing for us when we were kids. We got money for communion or graduation, maybe, I don't know what it was. And he created an account for us that we were custodian owners of. And when I became 18, I took it over as an owner, and it's worth, I want to say it's worth $10,000, $12,000. And I've never put another dollar in it. It was from the growth that has occurred over that long period of time now, unfortunately, because I'm getting old. From starting at $2,500, it's grown to, I want to say it's actually $20,000 if I'm not mistaken. So it'll be just part of my retirement someday, and it'll keep growing until then.
Okay. We're getting close to our time, but I thought this was interesting.
Yeah, one thing I skipped over that I wanted to mention, I don't want to go back into the presentation, but there was the compounding. $1 million today, or 1 cent per day, compounded interest at 100%, meaning it would double every day. So I would say that I would want to take the $1 million today because it's $1 million. It sounds amazing. But if you actually see that example, that 1 penny can grow every day, will ultimately be worth 10 times that amount over, I'm sorry, not 10 times that amount, but over $11 million over the 1 month, because it's going to double every single day. So that's where that long-term compounding investment comes from, and interest. It's amazing. So I skipped over that, Michelle. I apologize.
That's okay. The Rule 72 is important, and compound interest of again, yes, taking $1 million seems great, but taking that $1 million and investing it,
Yeah,
you'd even be richer than this penny.
absolutely.
Yeah, so I would take the $1 million and then just invest it. Have more money. But what are your thoughts about Bitcoins as an investment?
It scares me, truthfully. I won't lie. It is the future, of course, because that's where people want to, they talk about the future of the dollar and money and how people will transact business. It's clearly the future. Cryptocurrency is the terminology for any of those types of things. Bitcoin, I hate to call it Doge, DOGE coin, Doggy coin, Doge. Those things have taken off in value because people are feeling like they'll have a larger value in the future. So basically investing, when you're looking at purchasing something, you're expecting an increase. You're expecting the performance to be there so that the company pays you an interest in return, as we've talked about. And that's why those are increasing, is because most people believe that they're the future and that they're going to improve so much. It scares me because I'm a traditional banker. I've been in banking so long, I've seen how slow those things are adopted and how difficult it is to roll out to the mass market, meaning the great majority of people. But obviously technology has improved everything we're doing, including what we're doing right now. So it's interesting. It's worth reading about, but I personally am very scared of it right now. I think it's got a
Yes.
huge risk involved for loss. Huge.
And is that the same thing that applies that if you're under the age of 18?
Definitely. You have to be qualified to purchase it. So you actually have to go on to a currency exchange to buy those types of things. You couldn't, for instance, you couldn't use an E-Trade account or come to TCF Wealth Management to buy Bitcoin. You actually have to go on to the market to buy that, which makes it even riskier, in my opinion, because there's nothing to verify that marketplace is valid.
Okay, very good. I appreciate that knowledge because, again, you hear a lot of these days about the Bitcoin and from Elon Musk and a lot of influencers that are pushing more and more. But again, it's not knowing much about it in the long term.
True.
So I do. So I appreciate your time today, Mike, and touching on investing. I know there's a lot of information that can be covered, and a half an hour doesn't cover it all, but I do like the PowerPoint slides that you showed with the pyramids, and then depending where you are in your life, whether you're young, starting out and investing long-term, or if you start late in life, what you have to do. So in those choices. But I do want to make everybody aware that this session has been recorded and it will be uploaded to our JA Inspire platform so that you can access it 24/7 and share this information. And I appreciate everybody's time today. And thank you, Mike.
Thank you.
Job.
Have a good day.
Okay.